Hi, this is Shiv Yakub. In today's lecture, we are going to cover past exam paper question of international investment appraisal. Let's move to the requirement first. Discuss the possible benefits and drawbacks to Imani company of setting up its own assembly plant in Yilandwe compared to licensing a company based in Yilandwe to undertake the assembly on its behalf. So in first part, there is a comparison between direct investment and the licensing. Remember, direct investment means you will go to that country, you will set up your own plant, and you will start selling your own made products. There is a lot of investment will be required. There is a disadvantage of direct investment, but there is advantage. You can maintain the quality, you can maintain the brand image, 100% revenue will be accrued to you, plus nobody can copy your products or copy your license, copy your formula. In licensing, less amount of funds will be required because you will give some other person the right to develop something. So actually there is no input cost is required. But the other company will not give you the 100% revenue. Other company will give you the licensing revenue, licensing royalty, or the share of profit. So the inflow will be lowered compared to the direct investment. Plus, there are some risks attached with the licensing, and those risks are if that company who have obtained license from you does not keep the quality same, it will hurt your reputation. And the second important point is that company which obtained license from you may copy your license, may copy your formula, may copy your product, and after few years will start its own brand. Obviously, it will hurt you and it will dent your profitability. So that there is a comparison between the drawbacks and the benefits of licensing compared to the direct investment. Then in B part, prepare a report which evaluates the financial acceptability of the investment in the assembly plant in Yilandwe. In B part, we are going to discuss the financial acceptability of the investment in the assembly plant in Yilandwe. 21 marks. And in second part, discuss the assumptions made in producing the estimates and the other risk and issues which company should consider before making the final decision. And the third, provide a reasoned recommendation on whether or not company should invest in the assembly plant in Yilandwe. And you have to actually in third part you have to make a conclusion that whether you are going to invest in that project or not. Professional marks will be awarded in part B for the format, for the structure, and for the presentation of the report. Now let's move to the text. Yilandwe, whose currency is Vyar, has faced extremely difficult economic challenges in the past 25 years because of some questionable economic policies and political decisions made by its previous governments. Although country population is generally poor, its people are nevertheless well educated and ambitious. Just over 3 years ago, new government took office. Since then, it has imposed a number of strict monetary and fiscal controls, including an annual copper tax of 40%. So tax in Yilandwe is 40% in an attempt to bring Yilandwe out of its difficulties. As a result, annual rate of inflation has fallen rapidly from a high of 65 to its current level of 33. These strict, these strict monetary and fiscal controls have made government popular in the larger cities, but less popular in the rural areas, which seems to have suffered disproportionately from the strict monetary and fiscal controls. So here are two challenges faced by that country, which may become challenges for you, because if you want to open subsidiary in that country, it will become problem for you if country country still facing the economic problems. So first one is the economic challenges. So in future, if company still face the economic challenge, maybe company impose some block remittance type step. So you have to get ready for that problem. So keep this into mind that company is currently facing economic challenges. Plus, there can be the political risk because government is popular in the larger cities, but government is not popular in the rural areas. So maybe next election, usually which every country holds election after 4 to 5 years. So maybe after in next election, your government change, and if government changed, definitely your company will face, maybe your company will face some issues from the next government. So there are two challenges here: economic challenges and the political risk. Then it is expected that Yilandwe annual inflation rate will continue to fall in the coming few years as follows. Year 1 inflation is 22, 14.7, 9.8 onwards. Government has decided to continue the progress made so far by encouraging foreign direct investment in the country. Recently, government representatives held trade shows internationally and offered businesses a number of concessions. So this government is offering concessions. What is political risk? Maybe next government can withdraw that concessions from you. Zero copper tax in the first 2 years. Zero copper tax. An opportunity to carry forward tax losses and write them off against future profit made after the first 2 years. So, if there is any loss, you can carry forward those losses to the profits after first 2 years. The government representative also promised international companies investing in Yilandwe prime locations in towns and cities with good transport links. Okay, Imani, a large listed company based in USA with US dollar as its currency, manufacture high-tech diagnostic component for machinery which it exports worldwide. After attending one of the trade shows, Imani company is considering setting up an assembly plant in Yilandwe where parts would be sent and assembled into the specific type of component. What is trade show? Trade show is generally it's kind of an event organized by like Yilandwe company, in which company will market uh, eh, it's usually an event organized by the businessman of some country, supported by the government obviously, in which that businessman or the government usually market their country for the foreign direct investment. So Jalandev hold a trade show in USA, and by attending that trade show, your company may get impressed, and your company wants to set up a plant in the Yilandwe. Once assembled, the component will be exported directly to a company based in European Union. These exports will be invoiced in euros. So you want to set up a plant in Yilandwe, and you will make some products there, and then you will export those products to the European countries, and your sales will be in euros. But remember, you will have to write everything, every data in YR, in subsidiary currency. Because remember from the previous lecture, we have learned that we have to write everything in the subsidiary currency, and till the net cash flows, and after net cash flows, we will convert those net cash flows in the parent currency, and then we will write all the data in the parent currency. So only two currencies will be used. All data will be in the subsidiary currency till the net cash flows. Then we will convert those cash flows into the parent currency, and then we will solve or discount those parent currency cash flows, obviously after doing some adjustments. It is initially assumed that project will last for 4 years. This is life of the project. The 4-year project will require investment of 21,000 million for land and building. So for land and building, you need 21,000 million, 18,000 for machinery, 9,600 million for the working capital. The working capital will need to be increased annually at the start of each year by the inflation rate, and it is assumed that this will be released at the end of the project life. It can be assumed that assembly plant can be built very quickly and the production started almost immediately. This is because the basic facilities and infrastructure have already in place, as the plant will be built on the premises and on the ground of a school. The school is ideally located near the main highway and the railway lines. As a result, the school will close and the children currently studying there will be relocated to other schools in the city. The government has kindly agreed to provide free buses to take the children to these schools for a period of 6 months only. So there is another issue, ethical issue. You're opening a school on the premise, you're opening a factory on the premises of a school, ethical issue. Government, that company should provide proper remedy for this issue. Otherwise, currently it is ethical issue. Later, when the government change, it will become a social issue. Current selling price is €700, and this price is likely to increase by the European Union inflation rate from year 1 onwards. Sale components are given. The parts needed to assemble in the component Yilandwe will be sent from the USA. So the parent company is sending some raw material to the subsidiary company at a cost of $200, on which company would currently earn a contribution of $40. However, company feels that it can negotiate with the government and increase the transfer price to $280 per component unit. So that means you will be able to increase the cost of component or the price of the component to $280. When it was at $200, you were earning a contribution of $40. Now you will earn a contribution of 40 plus 80, $120. And we will assume that Yilandwe government will accept this offer, and you can increase the price to 280. The variable cost relating to assembly the plant in Yilandwe currently 15,960 per component. Current annual fixed cost is 4,600 million. All these costs wherever incurred are expected to increase by that country annual inflation rate every year from year 1 onwards. Company pays corporate tax on profit annual rate of 20% in the USA. So tax is lower in the USA, so there is no adjustment of additional tax. Tax in both US and Yilandwe is payable in the year the tax liability arises. Bilateral tax treaty exists. Tax allowable depreciation is 25% only on a state line basis. Mining company will expect annual royalty from the assembly plant to be made every year. Normal annual royalty fee is $20 million, but company feels that it can negotiate this with the government, increase the royalty fee by 80%. So we will assume that company will be able to get the successful negotiation, and the royalty will increase by 80% to 36 million. This will be an assumption. Once agreed, this fee will not be subject to any inflationary increase, so royalty will not change with the inflation. If company does decide to invest in the assembly plant in the Yilandwe, where exports from the USA to European Union will fall and it will incur redundancy cost. So this is the parent company expense. Obviously, if parent company starts a new factory in Yilandwe, obviously at previous factory your production will fall and you have to redundant few employees, and these are the redundancy cost. Company normally uses its cost of capital 9%. However, the finance director suggests that company use a project specific discount rate of 12% instead. So obviously we will assume that this 12% reflects the risk of the Yilandwe project, and this is a suitable discount rate, so we will use 12%. Current spot rates are given euro per dollar, YR over euro, YR over dollar. YR per dollar we need for the conversion of subsidiary cash flows into the parent cash flows. Why we need YR over euro? Remember, sales were in euro and you have to convert sales of euro into YR. That's why this exchange rate is given. Examiner is kind here. Examiner has calculated future spot rates. Otherwise, you have to calculate the spot rates based on inflation. European Union next 2 year inflation is 5%, and from year 3 onwards inflation is 4%. USA inflation rate is 3%. Normally in international investment appraisal, first calculation is to forecast exchange rates, but here exchange rates are given, so we will start with the first working, that is of sales. So let's start the working. We have to make all the pro forma in the subsidiary currency. The subsidiary currency is YR. So YR in million. Then write years. 0, 1, 2, 3, and 4. Obviously, performer is of 4 years. Let's do the working of revenue. Let's do working here. Now, let's write all the units, and I'm writing all the units in millions. In year 1, units is 150, that will be 0.15. In year 2, units are 480, that will be 0.48. In year 3, units are 730, that will become 7.73. In year 4, it will be 0.36 units. Now, write the price, add inflation of EU inflation. And remember, the EU inflation is, it is 5% for next 2 years, then 4%. First year it was 700 into 1.05, 1.05. Then in next onwards it is 4%, 0.4 into 1.04. Now, if I multiply units with the price, answer will be in euros. But I need answer in YR, so that's why I will multiply it with exchange rate. Exchange rate will be, I need exchange rate YR over euro. And it is given in the question. YR over euro. 165, 180.2, 190.2, 200.8. Now calculate the revenue. That is units into price. So answer will be in euros. Now multiply with the exchange rate. This is K8. Now copy all the cells here. K8. So firstly, you will calculate revenues. Now calculate the variable cost. Variable cost is given, but inflate all the variable cost with YR inflation. Add YR inflation. That is 1.5. It was given in the question. 15960, and the inflation rates are 22, 14.7, and 9.8. 14.7. Next year it will increase with 14.7. And next year it will increase by 9.8. Now calculate the total variable cost. That is units into variable cost per unit. This is cell number I11. Now create a link here. Now let's calculate the component cost. Remember, the component cost was, it was 280. We have assumed that our company will negotiate with the government and price will rise to the 280. And it is given in dollars. So every year it will increase with the inflation of dollar inflation rate is given at 3%. 280 into 1.03, and every year it will increase with 1.03. But if I multiply component cost with the units, answer will be in dollars, but I need answer in YR. So I need exchange rate, that is YR over dollar. And it is given here YR over dollar 120.1, 133.7, 142.5, and 151.9. 3.7. Now calculate the total component cost. That is units into component cost per unit into exchange rate. That's how you will calculate the component cost. And it is I-16. So create a link here, I-16. Okay, now calculate the royalty. Royalty every year is 36 million. But it is in dollars. But I need royalty in YR. So what I will do, I will multiply this royalty with the exchange rate, which is stated above, which is given above, which I have written above. This is I-19. I will write here, link here, I. Okay, we have calculated revenue, we have calculated variable cost, component cost, royalty. I think fixed cost is there. Fixed cost. And obviously it will also increase with inflation. And every year it will increase with the inflation of 22, 14.7, and 9.8. And what about the fixed cost? Fixed cost was 4,600. $14.7. Now calculate the capital allowance. Tax depreciation. And that is 25% on machinery. Machinery cost is 18,000. 18,000 into 25%. Copy it to the next cells. Now I think I have calculated all the expenses. Now calculate the taxable profit. Revenue minus all expenses. You can also take the sum of all expenses, or you can do it separately. Now next is tax. Obviously there is no tax in the first 2 years. Tax rate is 40%. There is no tax in the first 2 years, but in third year you will carry forward the loss of year 1. It will be netted off against the year 3 profit, and then you will take the tax here. So it will be calculated like this. This profit minus this. You will deduct 4360 from 45013. I have taken the positive sign because profit is already in negative. Otherwise, it will be added back to the 45,000. So that's why I have taken the positive value, because the minus minus will become plus. So you will deduct 4360 from 45,013, and then you will apply the tax 40% here. It will be 16,261. Or if you take the negative value, and add back the depreciation, now calculate the working capital. So I will calculate working capital here. First of all, calculate working capital requirement. In year 0, it is 9600, and every year it will increase with the inflation. First year 1.22, and second year it will be 1.147, in third year it will be 1.098. Obviously in fourth year there will be no working capital, because you need working capital 1 year in advance. Now calculate working capital change. First year, write the working capital as it is. And second year it will be the change of 2 year of year 0 and year 1. And last year working capital will be recovered. Right here, I-22. Amount is 21,000 for the land, 18,000 for the machinery. It's 39,000. There is no scrap value. Calculate the net cash flows, and it is the sum of all cash flows till taxable profit. These cash flows are in YR. Now write the exchange rate here. YR over dollar, because I need to convert cash flows in dollars. So in first year, exchange rate is 101.4, and next year I have already written here. Now all the data will be in remittance, YR cash flow over the exchange rate. These are remittance. There will be no additional tax, because in USA tax rate is only 20%. Now write the parent company cash flows. First one is royalty. And every year royalty is 36 million. $36 million. All data here now will be written in dollars. And its tax impact, tax will be at total 20%, because and on royalty you haven't paid any tax in the subsidiary country. Now you will write the contribution here, and you need to calculate the contribution, because parent company has sold components to the subsidiary company, and now you will calculate the contribution. Remember, the contribution per unit was 120, because when you were selling for $200, you were earning $40 contribution. But now you have agreed to sell the components at $280. You have increased the price by 80. When you have increased the price by 80, this 80 and plus the existing 40, total contribution will be $120. And every year this contribution will increase with inflation of 3% of the US inflation. So the contribution will increase with dollar inflation. So first year it will be 120 into 1.03. Now multiply this contribution with the units. It will be the total contribution. Multiply this figure with the units, and units are written above here. This is I-25 right here. I-25. You have to pay full tax on it. You have to pay full tax on it because you haven't paid anything in the subsidiary country. Is there any adjustment left? Yes. There is one adjustment, that is redundancy cost. But redundancy cost is minimal. It's very marginal. 20,000, 56,000, 57,000, 59,000. It is approximately near to 175,000. 170, when you convert, remember we have done all the data in $1,000,000. When you convert this into millions, it will become 1.175 million. It is immaterial. So we will not consider redundancy cost here. Why? Because it is immaterial. Calculate the net cash flows. Now discount all the cash flows with a discount factor of 12%. There are two ways to calculate the present value. First one is the traditional way, that is, write the 12%, 1.12 raised to power minus year, link it with the years. Copy into the next cells. The present value will be and now calculate the NPV. Sum of all these cash flows will be NPV. It is 147 million. So answer is 147.48 million. That means we will accept the project. There is another way to calculate the present value. That is NPV. Present value of cash flows. It will be the present value of cash flows from year 1 to 4. That is, write NPV, start bracket, rate is 12%, comma, take all the values, present value. Now deduct the investment. Investment is 479 obviously. So the NPV will be 147. This is another way to calculate the NPV. That's how you will solve your international investment appraisal question. Let's discuss the theoretical parts of this question. A part discuss the possible benefits and drawbacks to the mining company of setting up its own assembly plant in Yilandwe compared to licensing. Then let's discuss the assumptions made in producing the estimate and other risks and issues which companies should consider before making the final decision. And then provide a reasoned recommendation. Let's go through the answer and make some points. Benefits of on investment as opposed to licensing. Company may be able to benefit from setting up its own plant as opposed to licensing in a number of ways. First one is Yilandwe wants to attract foreign investment and willing to offer a number of financial concessions which will not be available in case of licensing. So by direct investment, you get number of concession. And another one is company may be able to control the quality of the components more easily compared to licensing, because in case of licensing, you will be dependent upon the other company. And next one is company may also be able to maintain the confidentiality of its product, whereas assigning the assembly rights to another company may allow the company to imitate, to copy it more easily. Investing internationally may provide opportunities for risk diversification, especially if a mining company shareholders are not well diversified. Finally, direct investment may provide company with new opportunities in the future, such as follow-on options, like you have the option to diversify into other activities in future. You have the option to invest in other projects which may be available if you present there. So what are the common drawbacks? Direct investment in a new plant will probably require higher upfront cost. It will require huge initial investment, which may not be the case in licensing. It may be able to utilize all these saved costs on other projects. A mining company will most likely be exposed to higher risk involved with international investments such as political, cultural, and legal risk, which may not be the case in licensing, because in licensing, local company will be involved and local company can easily deal with the political, cultural, and other legal risk. A mining company, on the other hand, will need to become familiar with the local system and culture, which may make time and make it less efficient initially. So you need time in case of direct investment to get familiar with the local system. Investing directly in Yilandwe will mean that it costs a mining company more to train the staff and possibly require a steeper learning curve from them. However, the scenario does say that country has a motivated and well-educated labor. Okay, let's move to the B part. In B part, you have done the calculation, and you have to write about the assumptions and other risk and plus the recommendation. So whenever you want to make a report, your first paragraph will be the introduction. Firstly, you will write the subject, then you will write the introduction. Here, subject is examiner has given the subject in only as a heading, report on the proposed assembly plant. This is the intro paragraph. The report considered whether or not it would be beneficial for a mining company to set up plant assembly in Yilandwe. It takes account of the financial projection presented in Appendix 1 and 2. Discuss the assumptions and discuss other non-financial factors. So in introduction, you will write that what you are going to discuss in the report. Obviously, you will discuss the financial implication, you will discuss the assumptions, you will discuss the other issues and ethical issues. So what are the common assumptions? It is assumed that all estimates such as rail sales revenue, cost, royalties, investment, working capital, all figures are accurate. Obviously, there is considerable uncertainty surrounding the accuracy of these, and small changes then could change the forecast of the project quite considerably. A number of projects using sensitivity and scenario analysis may aid in the decision-making process. So remember one thing, whenever you take any assumption, that can become limitation. For example, you are making an assumption that sale price will be this, royalty will be this, working capital will change like this. These figures are estimation, and remember, estimations are prone to error. So by using sensitivity and scenario analysis, it will guide you, it will help you in decision making. It is assumed that no additional tax is payable in the USA for the profit made during the first 2 years. It is also an assumption that in Yilandwe there will be no tax in first 2 years. It is an assumption that Your parent company, US country, will not charge you any tax in the first 2 years. No details are provided on whether or not the project ends after 4 years. You can write this assumption every time in the investment appraisal question, that why a project is ending after 4 year or 5 year. There is no detail normally given in the question. If your project is a positive generating NPV project, if your project is generating healthy revenues and profit, then why are you closing your project after 4 years? By reducing the life, you are underestimating the NPV. So this is an assumption which is made, but the project may last beyond 4 years and therefore may yield a positive NPV value. Additionally, even if the project ceases after 4 years, no details are given about the sale of the land, building and machinery. What happened with the land, building and machinery? Nothing is given here. It is assumed that increase in transfer price of the parts sent from the USA directly increases the contribution. This is probably not an unreasonable assumption. However, it is also assumed that negotiation with the government will be successful with respect to increasing transfer price and the royalty fee. So we have taken the assumption that Imani company will become successful in negotiation with the Yilandwe government, that they will increase the transfer price from $200 to $280, and plus they will also increase the royalty from $20 to $36. So you have to write about this. Cost, you have taken the cost of capital 12%. So it is stated in the question that this is project specific. So you are taking an assumption that this 12% will take the risk of the project, will take into account the risk of the project. So this will be an assumption. Although the project states that the scenario states that project can start almost immediately, in reality this may not be possible. It is assumed that future exchange rate will reflect the differential in the inflation rate, but seriously, every year exchange rate does not reflect the inflation properly. Although we assume exchange rate based on purchasing power parity theory, but normally purchasing power parity does not prevail in short term. Other risk and issues. Investing in Yilandwe may result in significant political risk. Why is it so? Because your government is popular in the urban areas but is not popular in the rural areas. So maybe in future, in next election, government may change, and if government may change, next government may put pressure on you and next government can take back the concessions. Imani company needs to assess the likelihood that it will be allowed to increase the transfer price of the parts and royalty fee. Whilst it may be of the opinion that currently Yilandwe may be open to such suggestion, this may depend on the interest the government may get from other companies. So what is the problem with this? If Yilandwe government allows you to increase the royalty fee and the transfer price, other companies operating in the Yilandwe will also put pressure on the government to increase the transfer price. So it may create problem, it may create risk for you. Mining company needs to be careful about the ethical stand and its value and impact on the reputation, given that a school is being closed in order to provide it with the production facilities. So you have opened your factory on the school. This is an ethical issue. You have to provide proper remedy. Either you open a new schools nearby, or you may provide transportation services for at least for 4 years, because government is ready to provide services for the 6 month only, and after 6 months it will create cost burden for the parent, and this will become a major issue in future. So a mining company should do something like open a new school nearby or should provide transport services for 4 years. Mining company need to take account of the cultural risk associated with setting up a business, the way of doing businesses, and obviously the employee may need substantial training to adopt a mining company way of doing business. Company should consider these points as well. Company also need to consider fiscal and regulatory risk. Company may need to assess the likelihood of changes in tax rates, laws and regulation, plus inflation as well, and setting up strategies to mitigate eventualities which can be predicted. In addition to these, a mining company should also consider and mitigate as far as possible operational risks such as the quality of components and maintenance of transport links. These are the general points. You can write these points every time in the international investor appraisal question. A mining company should assess and value alternative rail option which it may have. For example, it should consider whether licensing the production of the component to a local company may be more financially viable compared to this. It should consider alternative countries to Yilandwe, which may offer more benefits. Then recommendation result from the financial projection is that project should be accepted because it result in a positive NPV. Whenever answer is positive, you will write the positive recommendation, but you will write a word however, and then you will write that you should consider other points. It is recommended that financial projection should be considered in conjunction with the assumption, the issues, and the implication of these before a final decision is made. There is considerable scope for further investigation analysis. This is a general statement, and you will write always these statement in international or normal investment proposal question. It is recommended that sensitivity and scenario analysis be undertaken to take into consideration continuing the project beyond 4 years. The value of any alternative rail option should also be considered. So remember one thing, always write about the life of the project, limited life of the project. These are the general points you will write in every investor proposal question. You will write about the limited life of project. You will write about the rail option scenarios, like what are the rail option scenarios. We will study this later on, but the common examples are, if you have entered into a country or if you have opened a new project, after spending few years on that project, you have the right to expand the project. You may get the right to diversify into other activities. You are getting an experience, and by using that experience, you will open a new project. It's not possible that you have opened a project and after 4 years you will close a project, and the everything will be finished. No, there are some certain opportunities which may be available after doing this first project. So you have to write about that. And plus you will also write that you will perform sensitivity and scenario analysis every time just to improve the project. And you will also write that these are the estimates, and estimates are prone to error. We should perform the sensitivity and scenario analysis to improve our working. Okay, consideration may also be given to the issues and risk factors beyond financial considerations, such as the impact on the ethical stance of the company, the impact of its image, and if the school affected is close to accommodate it. Okay, at the end you will write that report is compiled by and date. Obviously you do not have to write your name here. You will only write report compiled by. You can write ABC or XYZ, then you will write the, then you can write the date. Thank you so much.